You ever wondered why most traders lose money even when they have a winning strategy? Now, between both of us, John and I have traded millions and millions of dollars worth of positions. And in today's video, we're going to discuss how the top 1% of traders manage their positions, which is completely different from what most people do. We're going to get into detail the real reason most traders lose money despite having a winning strategy. We're also going to talk about why we believe trade management is more important than your trading edge. We're going to get into the easiest way right now to improve your trading profits without changing your edge. And finally, the one change you could make today to stop losing money on trades that are no longer working, slightly profitable, but you're not sure what to do. We're going to give you exact steps. We're going to drop you right into a recent coaching session. And in the description, you'll find a link for the transcript for this entire call. If you have any questions, follow up, leave a comment below the video. I hope this is helpful. Yep. So, John, let's hop into something else that has also been a little bit of a frustration, for lack of a better way of putting it, for a lot of new members, which is trade management. I've been spending a lot of time on the game plans recently, trying to walk people through. You either believe in the idea or not. It's very ironic, especially when people come into our community, where I think the dream or the ultimate, whatever the ultimate experience in trading would be. I forgot exactly how you worded it before, but look at things for maybe a half hour to an hour and then go golfing or whatever anybody else likes to do on the side. But there's this tendency to micromanage, and not let the trades play itself out. How can we help coach everybody through that?
Yeah, it's definitely a challenge, and I think that from what I see out there, it's a very underserved topic. As far as, it's very easy to give trade ideas. It's very easy to look at a chart and say, hey, this is what we should do, and so on and so forth. But once you're in it, or once you're in several trades at once, what do you do, right? That's a great question. I would start by having, first of all, trade management should be decided before you get into the trade. So that's step one, understanding that managing a trade should not be a shoot from the hip type of thing where you're in a trade. Now, what do I do? If you're already in that situation, then you haven't prepared properly for the trade that you're in. So I want everybody to understand that. So the first thing you have to do, and I have a very methodical process, I have my test strategy, right? Where first I determine what the edge is. Why am I justifying getting in this trade? Out of all the 10,000 choices, why am I picking this? Now, it could be technical. There could be some news behind it. It could be a little bit of fundamental even. It could be earnings. It could be whatever. But there's got to be a reason. Usually for me, it's technical. 9 times out of 10, it's in an uptrend. It's in a strong sector. It's above both moving averages. It had a bull pullback, so it's providing a good entry point where it pulled back a little, and now it kind of bounced off a moving average, and it looks like it wants to move higher and take out a new high. So there, I kind of created an edge. So now I already know why I'm getting in, right? That's step one. Step two is now, what's my target? What's my entry? Am I going to wait for confirmation, or did confirmation already happen? What's my target price? So I already know my exit. I already know. So when I determine my target price, I already know, okay, I think it's going to go to $80. I think it's going to $90. Now, in options land, as well as I think with stock trading too, you could have multiple targets. You could say, you know what, there's resistance at 80 because that's where it made it a recent high after it pulled back. So as an example, that's going to be my first target. So now if it gets to that target, here's where management comes in. If I get to that target, what's the overall market doing now? Is the market still bullish? Did anything change since I entered the trade, right? That should be something you're thinking about from a management perspective. If the overall market and the sector and the underlying stock is performing well, then you should allow yourself a secondary target. So if then, you know what I mean? And that should be thought about before you get into the trade. So that's management. And then, okay, what about an early exit? So on the downside, let's say the market's deteriorating. The stock is not quite where it should be. It kind of languished more than you thought it would. It's going sideways. The whole market's not really helping it very much. Maybe there was sector rotation out of those groups that Maybe it's in a group where there was a sector rotation. So on the negative side, you should think of an early exit strategy. This is before getting stopped out. We'll talk about a hard stop in a second.
I was going to ask you about, like, that's been the biggest challenge is something, let's say it moves 5%
gray area.
and then pulls back to break even. Like
that's
the
trade management. That's trade management. That's the gray area, we like to call it, right? Where it's not getting a hard stop is a hard stop, right? But like if it's kind of like down less than, not as bad as a hard stop, but hasn't really performed the way you thought. Should I keep my capital? What little, everybody has a certain account size. So you want to move your money in the best place possible. Should I keep my money in this trade? Yes or no? So that should be thought about before you get into the trade. If you're already thinking about that and you're wondering about what to do while you're in the trade, you're already losing. You're already putting yourself in a bad situation because you're wasting too much mental energy thinking about what to do instead of just it's happening. So, an early exit would constitute, did the market change? Has the market broken trend? Has the sector kind of not been as popular as I thought it would be? Perfect example is the energy sector. Completely rolled over this week. I was in HES, H-E-S, right? Yeah. Got blown out of it. You know what I mean? And it is what it is. I didn't even think about it. It was what it was.
So funny. I actually commented, without reading your stuff, I actually commented the same thing. I said, this sector has so many moments in time where it looks like it's about to explode. And then within 5 days, it's at new lows.
It was in a nice early stage uptrend. So I stuck my toe in the water. You know what I mean? I went into HES. I liked the way the trend looked. It was a stronger. So again, I got into HES because we'll talk about a loser. So I got into HES because the sector looked like it was improving, right? It was in an early stage uptrend above both moving averages. And HES was outperforming at the time. HES was kind of outperforming the overall market. You know what I mean? So you could see why I would get into that like a week ago. It looked pretty darn good. And it pulled back a little bit into the 20-day moving average. You look at that candle from like maybe, I don't know, a week ago, when it was above the 20-day. See that big red candle where it was above the 20-day moving average? Yeah, I think my entry was there. You know what I mean? So I was like, all right, it pulled back. I have an aggressive entry. I should have waited for confirmation, but I'm an aggressive trader. So again, another thing you have to think about is what's my entry criteria for trade management? Am I an aggressive trader where I wait for a pullback and I get in, or do I wait for confirmation? Now, if you look at that little green candle the next day, that's sort of confirmation. That could have been okay, because look, it's showing some positive. It's not a sexy looking candle, but it's up from the day before, from the previous day's close. So, there you have it. So the next candle was kind of ugly. It looked like it just got mushed down. You have the upper shadow. So after that, then you got a lower shadow 2 days later. So there was a little bit of push and pull for a little while. You know what I mean? So I hung in there. But then once it broke the averages and the slope of the 20-day started to kind of go sideways, it started to get a little uglier. And then sure enough, on Friday, look at how nasty that is. So it's game over, hard stop, goodbye. And that was it. Now, I could argue when it broke the 20-day moving average, I could argue and say, well, my edge is gone, right? So you have to make a decision. Do I do a hard stop or do I stay in? And that's really a matter of how many trades are you in? What's your psychological, what's your trading style? Are you more aggressive? Or do you like to micromanage a little bit? Now, if you have time and you want to micromanage a little bit, you decide what's your edge criteria. When is my edge gone? When the moving average slopes downward, when it breaks the moving average, come up with some rules. As long as you have rules in place, you're going to be right sometimes and you're going to be wrong sometimes. But the bottom line is you don't have to think.
You also have to live with the results. That's really what I see in the coaching is a lot of second guessing. Where I'll use an example of a trade that I'm in right now that didn't exactly work. Actually, when I first put the trade on, it exploded. It did exactly what I wanted it to do. Like this was literally my entry, and those were the 2 days after that. Yep. Not only did we put the trade on, but we also added to the trade. Like we have a structure of where to put it on. But then with the market making new all-time highs, this thing just kind of kept melting down. Didn't stop me out according to my plan, but it's also not moving in my favor. So here's the point. If you could just allow me for 1 second, John, this is what I've been writing like long thought processes on the swing trading stuff. And I'm like, the trade's still valid. It's pulling back on light volume. I'm accepting the fact that if I get stopped out, the way that I manage my trades, John, is I have an entry and add share price. And when it hits the add share price, my stop loss gets moved from down here, which would have been a loss, now up to break even on my initial trade. So I'm risking break even on my initial entry, and I'm risking a loss on the second piece in exchange for the thing having plenty of room to take off if it does.
And yeah, and if you have that plan in place before the trade, you already know what you're doing. So that the whole trick to trade management is to not be stuck, not be in a trade and be like, oh my God, what do I do now?
And that's what a lot of people are doing right now. That's why I brought the topic
Yeah.
up today. There's a lot of people saying, I'm not sure what to do. When you know what to do, you wrote it down prior to the trade. We game plan them every single morning. The challenge is they're not listening to their own game plan. And they have this fear of, if I adjust this trade that I don't believe has the same edge, whether getting out or scaling back, I'm afraid it's going to move in my favor after I made that adjustment. And you have to live with it. That's the point that I want to get across to everybody. Whatever decision you make, you have to live with it, and you can't second guess or look back. That's the best decision you could make at that moment.
Yeah. So my best response to that is just get over it.
Exactly. I have a hard time saying that at 8:30 in the morning when we do the game plans, because I want to be encouraging and I want to have an open discussion about it. But eventually it does come down to that. That's the decision you made. If you're not comfortable with it anymore, you can scale back as well. We still like the idea, but it's pulled back like this one. It's pulled back much further than I would have wanted it to. I've been very clear to everybody that in my day-by-day analysis that I'm writing for the swing trades, is it pulling back on light volume. It's still valid. Like, I'm not seeing any other than price pulling back. It's still a valid idea. But I plan to do that before the trade.
Yeah.
So I'm not, if I get stopped out, I get stopped out. I'm not going to second guess. But what I'm telling everybody is, like, if you don't like it anymore, just scale back. You still have a small piece in your position summary. And if it, God forbid, it does exactly what you thought after scaring you a little bit, you can put shares back on.
Yeah, I think on the option side, if you're swing trading, I think there's a couple of things you need to address when you're trying to come up with a trade management plan. One of it is, what type of entry do I want? Do I want a confirmation entry, or do I want to be more aggressive? Like in the case of Hess, do you want to get in at that red candle when it's already potentially could go down more, right? Because it's a nasty candle. Do you get in at 4 p.m. on that day when it just kind of touches that moving average? Or do you wait for the next day for it to confirm back to the upside? And I think, that depends on your personality. Now, there's pros and cons to each one. One method, the more aggressive method, is to get in on more trades. So you'll get involved in more stuff. You'll probably get stopped out more. You'll probably have a lower winning percentage. But here's the good news. The good news is the trades that work, you'll get a more favorable entry price. And you'll probably have a slightly more profitable trade if it works, right? That's number one. Number two is, what does it mean for your edge to be gone? So to me, it
great
means,
question, by the way.
So to me, it means, okay, go back to top-down analysis. Have the markets changed? Now, the energy sector completely disappointed me last week. So yes, the edge itself has been deteriorating. So even if Hess was to outperform, let's say Hess continued to do okay and kind of go sideways and not really break the 50-day moving average or go down, I would maybe consider exiting early anyway, because again, the sector looked a little shaky. So maybe I would have reduced my position. These are things to write down and consider. If this happens, I'm going to do this. If the sector breaks down, I'm going to reduce my names within that sector by 50%. Like, if then, you know what I mean? And that's that will help you develop your edge. It'll help you develop where you see management working for you, where you could decide what you're going to do before it happens. So to me, I tend to stay in things a little longer. My experience is markets tend to give you maximum pain, right? So
yeah, the uncle point.
Again, this goes back to just my personal experience. I believe that markets people understand moving averages. They see where things happen, and sometimes specialists or market makers, they'll set their stops right below it just to mess with people. So I tend to prefer to stay in things longer and be more aggressive getting in things, which means I'll tend to get hurt sometimes when we get a rollover, when we get a rotation. But what I'll do is to mitigate that, because I'll have a lower winning percentage. To mitigate that, I will position size myself small. So if I have a 2% rule, I usually start with a 1% position. And I build that position if I get validation that the trade is working. So I could go from 1% to 2% if I'm in positive territory. I'll stay in 1% if the stock is meandering or if the sector is meandering.
We actually spend a considerable amount of time on our game plans and on the coaching sessions talking about position sizing as a part of the trade itself.
Yeah. Position sizing is a way to manage a trade where again, it's all about rules, and don't break your rules once you set them. Be like, okay, to me, a starter position is maybe 0.5%, and then see how it goes. If, let's say it's a very volatile name, let's say it's a straight call or straight put where it's a very aggressive strategy. And let's say there's an earnings play or some type of other thing going on, I'll do a starter position of like 50 basis points. And then if I get validation or confirmation that it's working, whether it be intraday or the next day, whatever, then I'll double down. And then I'll get up to 2% if it's really a great idea and it's really moving in the right direction. So that's on the positive side. On the negative side, I do the exact opposite. If I'm in a 2% position and the sector is deteriorating, I'm immediately going to cut it in half, even if the stock is doing okay. And so it's hard sometimes to put that on the Discord channel because it's happening dynamically in real time. But you have to have your own set of rules. But these are the rules that that I teach, that I try to in our coaching calls to try to explain to people. You have to develop your own sort of if-then scenarios
and stick to them. You have to live with them. I think that's the part that a lot of people are fearful of. That if they make a decision with the new information, that what if the stock actually does what they thought it was going to do? But our entire job is managing risk first.
Yeah.
And if you have in your mind, because right now we're talking about the negative side of the trade, we're talking about it moved in our favor, or we put the trade on, moved in our favor, came back, and now we're between slightly profitable. We had a profit 2 days ago, and now it's floating plus or minus 1% from our entry. It's okay to reduce your exposure, because if you got into the trade saying, here's what I expect to have happened, and it didn't, well, what you wanted to have happen didn't. So just cut your exposure down. You don't have to like bail out of the whole. If you got 1,000 shares, cut half off, cut 70%. It doesn't make a difference. You're managing risk. The other side of the trade, which is where I think a lot of people really need a lot of help mentally on, which I'm going to show you an example in just a second. I just couldn't be any more excited about something that somebody posted the other day. I'll actually take a snapshot of it so that we have a good picture of it, where is when you have a profit and you take it for the sake of taking it. Right.
That's, it's always great to have a profit, but again, if you're going against your plan and it could have been more, that's one of the things you have to kind of manage as well. I think one of the biggest things I think new traders struggle with is, well, if I come up with a management plan, which we just talked about, right? How do I know it's the best plan? And I think over the course of 1,000 trades, what you said is so important. Just have a plan. You know what I mean? If you have a plan and you stick to it, in 1,000 trades, sometimes it'll work, sometimes it won't. But if you kind of bounce around and change your mind and get in and get out and be all willy-nilly, you're not going to do well. You're not going to be consistent. If you have a plan and you stick to it, you can make changes and tweak it as you go along. You might have a certain
gain more experience. That I just want to throw that there. You can't really tweak it until you have enough trade examples,
right,
to make that distinction that I need to change it.
Yeah, like you might notice, hey, listen, it looks like after a whole year of trading, you go do your annual review, which everybody should do, by the way, right? Mm-hmm. You do your annual review and say, well, it looks to me like, I'm doing better on my long positions than on my short positions. Well, what the heck am I doing wrong? I'm doing the same routine. I'm doing the same stuff, right? One of the things I noticed when I first started doing this was that was my case. I was doing really well on my longs and not so great on my shorts. And I realized that, short positions have to be treated a little bit differently. As a general rule, markets tend to drift higher in a bull market. And when they pull back more violently, more quickly. So you kind of have to adjust your trading that way too. So, more aggressive trades on the downside, more straight puts, for instance, or, when markets do roll over, you could be but then, the biggest bull rallies happen in bear markets. So you have to be able to take profits quickly with bearish trades. So this took about a year for me to figure out when I first started doing this, and I was able to kind of put together a plan that made more sense. But this is what I mean. You need time, and you need to be able to get through that time to see what works for you. And that's And that's the key to doing it. It's not the right or wrong. It's just having a plan. Any CEO will tell you that, by the way. Sometimes a decision has to be made. It doesn't matter that, it could be the right decision, the wrong decision, but you can't have no decision. That's the key.